Listen, this is Robert, and I need you to pay attention because what's happening in the silver market right now isn't normal. We're not talking about a gentle uptrend. We're talking about a metal that just blasted through resistance levels like they didn't exist, and the aftershocks are rippling through every corner of the physical market. Dealers are scrambling, premiums are exploding, and the gap between what the screen says and what you'll actually pay for metal in your hand is widening by the hour. So here's what we're unpacking today. Is this the beginning of a structural shift that redefines precious metals for the next decade? Or are we watching the final blow-off phase before a correction that leaves late buyers holding the bag? Because the signals are mixed, and mixed signals in a parabolic market are exactly where fortunes get made and lost. Now, before we dive into the Mint's latest move, the inventory crisis at major retailers and why the futures market just threw up a red flag that nobody's talking about, I want to make something clear. I'm fighting back against content thieves who steal this work and water down the message. If you value original analysis, hit subscribe and drop a comment saying Robert OG, so I know you're part of the real community here. And because timing matters more than ever right now, I've set up a Telegram channel for rapid-fire updates, quick hits, breaking headlines, and observations that don't fit into a full video. The link is in the description. Join it so you're not blindsided when the next move happens. Overnight. All right, let's get into it. Silver just punched above $91, and the price action isn't behaving like a commodity. Commodities drift. Silver is detonating. You can see it in the volatility spikes, the intraday reversals, and the way dealers are adjusting their spreads in real time, like they're trying to avoid getting run over. And here's the part that changes everything. Gold is climbing too. When both metals move in tandem like this, it stops being a technical trade and starts looking like a confidence crisis. People aren't just buying silver because it's cheap relative to gold. They're buying because something else feels unstable. One way to track this dynamic is through the gold to silver ratio. As silver outpaces gold, the ratio compresses. And when that compression accelerates, it tempts traders to get cute, rotate positions, chase momentum, try to front run the next leg. But let me ask you something before you get clever. Are you positioning for a chart pattern or for a market where you might not be able to get physical delivery when you need it? Because those are fundamentally different strategies. Now, you'll hear the standard explanations for why silver is ripping. Central bank policy shifts, inflation fears, geopolitical instability. And sure, those narratives provide context. Dovish rate expectations tend to support metals. Uncertainty tends to support metals. Institutional credibility erosion tends to support metals. But those are surface-level triggers. The real story is what's happening beneath the headlines. Physical availability, capital flows, and the mechanical friction points that emerge when paper contracts and physical metal stop trading like they're the same asset. And this week exposed those friction points. Let's start with the east-west price divergence because it's not getting enough attention. When one major market is consistently paying a significant premium over another, that's not noise. That's price discovery screaming at you. If buyers in one region keep bidding up immediate delivery while another region trades at a discount, that metal flows toward the higher bid. And if that premium persists and widens, the lower-priced market either catches up or watches its inventory evaporate. That's one clean pathway to triple-digit silver without any conspiracy theories. Not hype, not hope, just capital allocation following the highest bid. Now, let's address the U.S. Mint situation because the narrative around it is getting twisted in both directions. This is not the collapse of the silver market. What it signals is more straightforward. Pricing infrastructure can't keep pace. Certain numismatic silver products were temporarily suspended while pricing models are recalibrated. Translation: silver moved faster than their internal pricing mechanisms could adjust. That matters. When a major government institution has to pause operations because input costs outran their published prices, it tells you the velocity of this move is extraordinary. The system is reacting, not leading. And then you look at the retail side. Costco has quietly become one of the most reliable indicators in this entire cycle. When a mass market retailer is selling out inventory, imposing purchase restrictions, and struggling to maintain product availability, it tells you demand is overwhelming replenishment capacity. They don't limit your shopping cart because they're trying to be difficult. They limit it because the drain on inventory is unsustainable. And here's what most people overlook. Even if the spot price is what grabs headlines, the physical market is where behavior actually changes. Out-of-stock alerts, extended shipping windows, and ballooning premiums are the signals that convert casual interest into urgent action. So if you're buying anywhere right now, brace yourself. Expect delays, expect back orders, expect dealers to protect their margins with wider spreads. That's not market manipulation. That's supply chain logistics colliding with a stampede. Now, while the physical market tightens, the futures market did something that should have acted as a circuit breaker. Margins. This is technical, but I'll make it simple. In futures trading, margin is the collateral you post to control a contract. When the exchange raises margin requirements, it becomes more expensive to hold leveraged positions, and that typically forces speculative traders to reduce exposure. In most rallies, this cools the momentum. But here's what makes this week different. The margin structure was adjusted so that margin requirements scale dynamically with price. In other words, as silver climbs, the cost to maintain positions climbs automatically. That's designed to be a brake, and yet the price kept accelerating. Underline that. That's not typical market behavior because it suggests either the buying pressure is robust enough to absorb the increased friction, or the market is under enough stress that conventional control mechanisms aren't functioning as intended. Here's a quick futures breakdown. A standard silver futures contract represents 5,000 ounces. At approximately $91 per ounce, that's roughly $455,000 in notional exposure. If the margin requirement is around 9%, you're looking at over $40,000 in collateral just to hold that position. And if that collateral requirement increases as the price rises, it's like running on a treadmill that keeps speeding up while you're already sprinting. So why would traders stay in? Because they believe the upside justifies the pain, or because they're hedging larger exposures, or, in some cases, because they actually need physical delivery. And that last category is where markets stop respecting normal limits. Now, you're going to hear analysts call this a mania and dismiss it. They'll attribute it to technical breakouts. They'll say it's just the interest rate narrative. Clean explanations are comforting because they make the chart feel predictable. But what's not clean is this combination. A major government mint pausing products because pricing can't keep up. A major retailer imposing purchase limits because inventory can't keep up. And a major futures exchange altering margin mechanics while the price continues to surge. That's not a neat chart pattern. That's a system under strain. Now, silver has always been the metal that behaves predictably until it doesn't. It can spend years grinding sideways, frustrating bulls and bears alike. It can consolidate while other assets trend. It can test your patience to the breaking point. And then, when conditions finally align, it can move so violently that it erases months of resistance in a matter of days. That's why it creates legends and wipes out accounts. But the critical question today is, what phase are we in? If this is an early stage breakout, the largest wave of public participation hasn't even started yet. If this is a late stage blow-off, volatility will explode, liquidity will vanish, and the shakeouts will be savage. So let's talk about participation, not just price action. A true mania isn't subtle. In a genuine mania, the public arrives late and loud. You hear about silver from people who've never mentioned it before. You see relentless media coverage. You see emotional, impulsive buying. You see panic selling. You see get-rich-quick energy saturating social media. And do we have that yet? Not completely. And that's what makes this move so compelling. It's powerful, but it hasn't reached full mainstream saturation. That suggests there might still be fuel in the tank. Now, quick reminder, because my analytics show something brutal. A huge percentage of people watching these videos aren't subscribed. If you want to support this channel and help the message reach more people, subscribe. Then comment Robert OG so I know you're here with the real community. And here's a thought you should sit with. Even after this run, the biggest question isn't how high can silver go. The biggest question is, what happens when everyone tries to buy at the same time? Because that's when the story shifts from chart analysis to supply chain analysis. That's why I keep emphasizing the signals that matter for physical buyers. Premiums over spot, backorder timelines, shipping delays, purchase restrictions. Those are the indicators that tell you whether demand is genuine and whether the distribution infrastructure is getting overwhelmed. Now, I want to revisit the international angle one more time because it's critical. If silver is consistently trading at a meaningful premium in a major Eastern market, it fundamentally changes incentives. Metal flows toward whoever pays the highest price. And if that premium persists, it creates pressure on lower-priced regions to reprice one way or another. This is why some analysts argue that paper prices are lagging physical reality. Whether you agree with that thesis or not, the premium itself is observable behavior. Someone, somewhere, is willing to pay more for immediate delivery. And that kind of behavior has a tendency to pull global pricing higher over time. Now, I'm not telling you to chase this move. I'm not telling you to panic buy. I'm not telling you to do anything reckless. I'm telling you to think strategically. In fast-moving markets, adrenaline clouds judgment and leads to costly mistakes. So get organized. Know what you own. Know why you own it. Know your plan before the next candle prints. And stay connected, because this market can pivot on a headline. That's exactly why the Telegram channel exists. Daily updates, critical headlines, and quick context without you having to hunt through noise. Also, a quick creative note. If you want to see silver-related success stories, real people, real wins, and the strategies that worked for them, there's another channel linked in the description. Go subscribe there too. Seeing how others built wealth can help you avoid repeating expensive mistakes. Now, let me ask you two questions, and I want real answers in the comments. First, if silver hits $100 in Western markets, do you think that becomes a magnet that pulls the price even higher, or a psychological ceiling that triggers the biggest shakeout of the cycle? Second, where do you think genuine price discovery is happening right now? In paper markets or in physical markets where buyers are paying immediate premiums for delivery? And while you're down there, if you've had any kind of success, paid off debt, built savings, hit a financial milestone, share it briefly. Not to brag, but to motivate. You'd be surprised how much that inspires other viewers to stay disciplined. Now, can anything stop this move? Absolutely. There are speed bumps. A sudden margin shock can force leverage players to liquidate positions. A liquidity freeze can make dealers pull back and widen spreads aggressively. A surprise policy announcement can flip risk sentiment and create violent reversals. So yes, the rally can stall, and it can shake people out brutally. But here's what most people forget. A consolidation doesn't automatically mean a reversal. Sometimes a market consolidates at a higher base and then resumes its climb, often right when people get comfortable calling the top. That's why I say don't confuse volatility with direction. Now, one thing I want to emphasize, because it keeps people grounded, is separating the headline price from the meaning of the price. Silver at $91 isn't just a number on a screen. It's a signal. And signals change behavior. They change how sellers think, how buyers think, and how dealers manage risk. They also change how institutions discuss silver in strategy meetings where, for years, silver barely registered as a topic. You can already see that shift in the fixation on round numbers. $90, $100, $120. Round numbers attract buyers, but they also attract traps. The closer we get to these psychological levels, the more you should expect games, head fakes, and violent shakeouts designed to scare impatient money out of positions. And every time silver starts moving like this, the narrative machine activates. Suddenly you'll hear, "This is the top. A massive correction is imminent. Smart money is exiting." Pullbacks do happen in silver, often with shocking severity. But notice the timing. The fear narratives intensify right when the move forces mainstream attention, because fear is a control mechanism. Fear keeps ordinary investors waiting on the sidelines. Fear keeps you second-guessing. Fear keeps you hoping for the perfect entry while the market reprices without you. That's why the mint pause matters beyond the product catalog. It's a real-world example of institutional systems struggling to update pricing fast enough. Some silver products aren't repriced in real time like spot contracts. They follow schedules, internal reviews, bureaucratic processes. So when spot prices sprint vertically, those products can temporarily become mispriced relative to replacement costs, and then they vanish from inventory, and then they reappear at higher prices. That's bureaucracy colliding with a parabolic chart, but it still confirms the velocity of this move exceeds normal operational capacity. Costco's purchase limits tell a parallel story. They're not designed to handle speculative buying surges. They're optimized for efficient inventory turnover. When they impose transaction limits, it suggests buying pressure is concentrated and repetitive, people returning again and again until inventory is depleted. That's what early stage mania looks like. A smaller informed group draining supply before the broader public even notices. And here's the critical question. If we're seeing supply strain before the full public wave arrives, what happens if the public wave actually hits? Because the public wave doesn't arrive gradually. It arrives all at once. Now, back to futures. For one crucial point, margin changes aren't just risk management. They're also pressure release valves. Raising margin forces leverage traders to post additional collateral or reduce positions, and that can trigger forced selling. So when margins scale dynamically with price, the system is essentially saying, we want more collateral backing this exposure. The fact that silver pushed higher anyway doesn't mean it can't reverse tomorrow. It means the bid is currently stronger than the friction. So stay practical. If you're buying physical, the biggest surprise in volatile markets isn't the price itself. It's the timeline. Orders take longer, spreads widen, products flip to unavailable status. That's not always malicious. Often, it's the supply chain absorbing an unexpected surge. And if another region is paying elevated premiums, metal naturally flows toward that higher bid, tightening availability elsewhere, even if your local spot quote looks stable. So watch the real indicators. Are your preferred products staying in stock? Are premiums rising? Are delivery timelines extending? And one final community reminder, if you want to maintain composure during moves like this, you need daily context, not just one viral price spike. That's precisely why the Telegram channel exists. Quick daily touch points so you don't get emotionally whipsawed by a single headline. Because in silver markets, the people who win are usually the people who had a plan before the chaos hit.